Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. Today on the show, we've got JF Tardif of Timelo Investment Management. He's been a hedge fund manager since 2012, and before that, he cut his teeth at Sprott Securities, and he is pretty stubborn about being a value investor. Yes, he tracks those momentum names, but he sticks to his knitting, often finding good ideas in Canadian small caps. He also shares an interesting story about how he got that job at Sprott Securities. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO InvestorLine. All right, In the Money listeners, you're constantly analyzing charts, spotting trends, and making calculated moves. That's where BMO InvestorLine comes in. Take your trading strategy to the next level with their advanced platform packed with real-time data, options analysis tools, and commission-free ETF trading. Start investing today at bmo.com/investorline. JF Tardif, thank you so much for joining me on the podcast.
But thank you for having me.
I've always enjoyed speaking with you, and I'm really excited to have a long time with you because I feel like in the past when we've had our 5-minute interviews, I'm always like, oh, I have like 7 follow-ups because you really get into these companies that are not your TSX 60 companies. How would you describe your investing style and the kind of stocks that you like?
Yeah, I like to call it opportunistic. So look at whatever is attractive and, all cap as well. I try to find more large cap, but it's difficult. And generally speaking, large cap are much more expensive. Like we've done preferred shares, we've done, converts. We've done all sort of things over the years.
How long have you had your own hedge fund?
Since 2012.
So that's a really long time to survive and thrive in the industry. And a lot of people know you, your fame comes from that group from Sprott Securities. So people think Sprott, then they think mining. What did you learn? What was sort of instrumental or foundational for you when it comes to your Sprott days?
Yeah, I would say Eric Sprott was very good at the macro. Back in, I was a client of Eric Sprott or Sprott Securities back in the day. And he would write a monthly comment that I would greatly enjoy every month. And he would talk about flow of money, he would talk about the Fed, he would talk about deficits. And up to that point, I really didn't do any macro. I was just stock picking and this company's doing well, no view on the economy. And in 99, he became very bullish on gold, very bearish on the economy. And, I thought it was fascinating. And one day I knew he was going more into the money management. I called him, hey, would you hire a guy like me to help you out? And he said, if you move to Toronto, yes. So there you go.
That's all it took.
Yeah.
I feel like that's a lesson for the kids today. Just pick up the phone, email and say, hire me. Yes. I think I'd do well for you. And so does that mean that mining is always something you like? Gold is always something you like? Or were there other skills that you picked up there?
Yeah, mining definitely. There was a lot of people, and Eric himself. There was John Ambry as well.
Yeah.
That in my Sprott years, they were doing a lot of mining. So I was hearing about all their stories. In the fund I was running, we didn't have a lot of focus on different areas for maybe different type of clients. So I didn't do that many minings, although I heard for so many years, so many stories that I feel I know a little bit. I'm not an expert, but I have general knowledge.
Yeah, and you'll go into mining, but you'll also be in kind of small caps that have nothing to do with that. Talk to me about the shape of your portfolio right now, because it looks like your investments in equities in general is pretty low.
Yes, I guess I've been too careful. Even now it's like running like super hot, like almost never before. We're careful.
What percent is in cash?
Yeah. It's hard to tell, because I short, right? And I don't tell people what I short because I don't want to offend people. But when you short, you get cash. But if you just want to look at the long side, we got about close to 40% equity invested. We have some REITs. We have some corporate bonds, some preferred shares. So we're maybe 60% invested from the long side. And then we have some shorts on the other side.
That seems low for when you consider the markets, both in Canada and the US, are at all-time highs.
Yes, yeah. I mean, if I could, now I know all of that. I wish I could go back 15 years and be 300% invested.
But why? Like, what is holding you back? I guess is the question. Because I feel like when you're talking, okay, I'm not super invested, and then the things you are invested in are pretty defensive. That tells me you've got some worries.
Yeah. Well, I'm fundamental first, right? And if you talk to people, I have lots of friends and acquaintances that are very smart, and and I ask, well, why do you own this stock XYZ? And well, it's now people are doing more. It's moving, and that's what I want to do. Fundamentals is one of the factor that is one of the lowest of importance. Even some quants now. I have a friend that follows these quants guys. And over time, the fundamental portion of the calculation has gone down and gone down and gone down. So fundamentals are not really that important right now. It's momentum, it's storyline, and it's ETF flow. ETF flow is a big thing. I spent a lot of time the last couple of years to understand it better. I wish I probably should have done that 10 years ago. This has a massive effect on the spread between the very large cap stocks, which take most of the flow in, versus the smaller type of names.
I love how honest you are about things that you wish you had done differently, but it sounds like it's still not enough for you to abandon, that quaint notion of buying stocks on fundamentals. And of course, I'm using that facetiously, but, I'll just throw out a question like, why don't you just jump into the momentum names? If you know that momentum is what is fundamental right now, like what's stopping you from just joining the party?
I guess legally nothing, but if you buy something, I'm sure it happens to you. It happens to probably everybody. I think this analogy you'll understand. If you buy something, it's no conviction. As soon as it will be a little scare, your weeks will be very weak, and you'll drop it and you lose money, right? So to own something for the long-term term, you have to have a conviction. Fundamentally, whatever your style is, you gotta have beliefs why you own certain thing. People have owned Tesla for all these years, despite some people saying it's way too expensive, including myself. For the longest time, they were growing and doing great. People had the belief, oh, this is a very special company, and they made a lot of money. So at least they had that belief. I'm not comfortable personally with extreme valuation. I'll just drop the stock as soon as there's a little scare.
And I feel like then we're getting to the heart of your investment style is you'll own things that you know well and that you're comfortable with.
Exactly.
And like that sounds obvious. I'll use myself as an example of what not to do. Sometimes I do get sucked into these momentum trades, and I don't know if you've seen all the hype around Opendoor.
Yes.
Have you seen? Yeah. Okay. Yeah. So I was one of those suckers who, when the stock was, maybe the momentum was going up, and I was like, you know what? I'm just going to kick. I like to see, what momentum trading gets me. Often nothing. And so I was one of the losers, the weak hands that chopped it, down 80% or something like that. And we talked to Eric Jackson, who was our first guest on the show, who's now kind of responsible for the stock up 300% in 3 weeks. And there's no point even mentioning what Opendoor even does, because that's obviously not why the stock is trading. It buys homes and it flips them. But talk to the investor who's looking at a stock like that, which, by the way, is the most actively traded stock in America today. Like, that's how much is behind it. It's not some sideshow. It's the most actively traded stock in America because of one guy who said it should go higher.
Yes, indeed. I mean, we were involved on the first big drop, not for a long time, but we did make money shorting it from the highs.
So we'll talk about some shorts.
But we didn't stay short all the way down, because these stocks can bounce 100% in a few days very fast. So we were involved, and in fact, on Friday, one of my team member mentioned it again and said, hey, maybe we should
short it.
Maybe we should go back in. And I said, well, maybe it's too early. And this weekend, I kind of relook at it. I actually look at Mr. Jackson's thesis, and I just don't agree with the multiple. I mean, they're talking about a multiple at the peak of 20 times sales. 20 times sales don't make any sense for a house. You know, if I buy your house and you give me a 5% discount, I resell it, I don't know if it's worth 20 times the price of the house.
Like, for context, the stock's trading at $3.50, which is like huge considering it was $1 a few weeks ago. And Jackson thinks it should be an $82 stock.
Yeah. But he's basing, I mean, what I read anyway, he's saying they're going to get to a certain size, apply the same multiple as the peak in 21, which was 20 times sales. But 20 times sales is just a ridiculous multiple.
Now, but there's so much danger in shorting a name like this. And so many, since you've been doing this since 2012, so many people have had their head handed to them in this particular environment where retail trading and meme stock trading, like, how do you stay safe on the short side in names with so much momentum to the upside?
Yeah. Well, I don't short them very often. So like I told my colleague, like, I don't think it's the time, but I'm curious. I like to follow these things. I have in my spreadsheet a bunch of meme stocks that I don't short. I just watch. It gives me an indication of sentiment, right? And so like it's very rare actually we short these it's because it's very dangerous. I mean, I can see very, very well that stock going to $10-15 in a month. It's very possible because there's a lot of people that like to play these stocks, right? So, but this is not fundamental. It's momentum. It's, I think I'm early enough. Maybe the company will press release some good numbers. Maybe they'll make money on the next set of houses they buy and flip. So, yeah. So not really for me on the short or the buy side, generally speaking.
Now, is that rooted in a lesson? Like, have you tried, you don't have to name names if you don't want, but like, have you tried to short one of these names before?
Yeah, I went Tesla. I'm a big fan of Elon Musk, by the way. I truly am. But in the past, the stock was, I thought, so expensive. And a lot of people agreed with that thinking. But the company was doing very, very well, grew substantially. And now they have the robo-taxis. People are very excited. So I was wrong. But, we have stop losses. If we start losing too much money, we just go away.
I mean, it's so interesting you say you're a fan of Elon Musk. Sometimes I think like the faith in Elon Musk papers over. Tesla's sales are going to fall this year. They're very likely to fall. And that hasn't happened in all its years as a public company. They're going to report this week. It trades at 177 times earnings. So you've got a company where sales are falling. But to your point, we hope like robo-taxis or robots in general will be the savior. He gets a really long leash,
yes,
longer than anybody else. You're such a natural skeptic, and I'm wondering, does that not apply to what Musk does?
Well, he's probably going to be successful on the robo-taxi to some extent. Waymo has probably the lead here, so we'll see. Personally, I think it's going to take more time than the bull people say. It's going to take a long time to be everywhere, in every city, every country, by everybody. So yeah, I mean, but it's going to grow every year. I have no doubt. Waymo and Tesla robotaxi will grow every single year, substantially every year.
But not a stock you own, Tesla.
No, still massively. It's close to $1 trillion company.
Overvalued. Well, and so do you not play in those large caps?
No, we try to find some large cap once in a while, but yeah, generally speaking, they're very expensive.
You mentioned in your portfolio, the REITs, the telcos, the corporate bonds. So you're clearly looking for defense, and you can find a lot of value in that space right now. How new is that position for you? And take me through kind of your high level thinking. We're going to talk specifics, of course, as we always do in the show, but high level, what's interesting about that space right now?
The telcos? Yeah. Well, the telcos we've been watching, in fact, like we were short some of those names like months ago. There was a price war.
Good for you. There
was a price war, right? You could tell. Yeah, there was Freedom. Freedom was very aggressive. I think they dropped their price to $35. My wife actually, I told her like maybe you should consider because their roaming is included. If you buy this package in US, you can pick a roaming package for Europe and other places. So, I go to US quite often, and the charges by Rogers is $15 a day, I think. So that's a lot. money so you can save. So, and then everybody started cutting prices to try to gain or stop the leakage of new subscribers. So there was a price war. So we were short. So every day, actually, one of my team member, every day was, basically looking at the price of all the competitors. And I say the day the price war is over, it's probably time to buy them.
You think it's over?
And we believe the price war is over, yes.
How are you expressing that in the portfolio? Because each of them seem to have their own headaches in addition to the price war, whether it's BCE and its dividend or Rogers and maybe leverage, TELUS and the issues it has with TELUS International. So how are you expressing that in the portfolio?
Yeah. Well, if you believe the price war is over and they're going to be more disciplined going forward. Also, I hear the thought that all of them or some of them could reduce their CapEx because of partially government rules. So if they do that, that's better for free cash flow. But basically, if you believe the price war is over, you want to buy the ones that got hurt the most. So which is Rogers and BCE. So that's what we own. TELUS is basically trading in line with its historical multiple. So, they should be okay, but not a meaningful move up. Quebecor is already up significantly. So that one doesn't have the upside of the end of a price war.
I noticed you don't have any energy stocks in your portfolio. A lot of value investors say, there's screaming value there. Is that historically a norm for you, or is there something in particular you've got energy stocks in the penalty box?
Yeah, just my view. I kind of share the view that I saw from RBC recently, 2 or 3 weeks ago. They wrote a piece that to rebalance the supply and demand of oil. I'm not talking and get natural gas, but oil. You need that price around $55. I believe there's too much oil. Saudi Arabia, particularly, I think they have enough of losing market share, and they're not going to tolerate a lot more loss of market share. So I think the price will stay below 70, 65, and potentially, if we have an economic slowdown, we could go to 55.
But a lot of these companies can survive and do well in that environment.
Yeah. Not all of them, if you look at the CNQ, for example, Long Life, Strathcona, which had a great podcast.
Thank you.
Also Long Life, lower costs. So those will survive 100%. But, generally speaking, investors are just going to sell the sector if that happens.
Did you buy Strathcona?
Not yet, because I actually listened to that podcast yesterday. So.
All right. Well, I'm glad we got some of your thoughts going on that one. Let's step into the mailbag and see what questions viewers have for you. Our first question in the mailbag is about Altus Group. This one coming from Cardi on X. What is your outlook on Altus Group and the real estate sector in general? Altus has been a bit of a sideways trader recently.
Yeah. Well, Altus has it's like the Bloomberg of real estate. So it has a special software. We used to own a lot of Altus back in the day when it was a turnaround. The stock went as low as $3 back in the day.
It's 53 now.
Yes. So it's done very well. But right now we're not involved. I find the stock very expensive. I also find the company disappoints almost every single quarter. People are excited about because they link software with maybe a 3x sales multiple, considering lots of software companies trades at 10 or above. So that's the upside that eventually the company will be taken over. And if I just look at the numbers, I just find this stock a little too expensive.
Do you care about takeover potential in general?
No, because if I wouldn't buy only on that reason. Because it's a binary situation, and unless you have insider information, which is illegal, so you can't buy. If you don't have insider information, you don't know, so it's a binary. So if you like it without it, that's just an extra kicker.
Now, you mentioned that you do have REITs in the portfolio, and one of your top ideas is a REIT, but just high level on real estate, to Cardi's question, is it ripe for opportunity right now?
Yeah. Depends, right? Real estate REITs are different sectors. So office is terrible, but maybe coming back as people are being forced to go back to the office. You got the retail, you got the industrial, which is doing very, very well, but it's also the most pricey. Then you got the apartment REITs. In Canada, population growth is come to a stall with a change by government policies of students and and so on. And then also like the REITs, generally speaking, every year for now, like 25 and 26, like these companies, they have stacked their mortgages renewals. So this year and next year, no matter what happens through short-term interest rates, their mortgage renewal will be substantially higher. So their cost of interest will go up for at least the next 2 years. So I would say that generally speaking, I don't expect a big move from REIT. So I don't expect them to go down. So if you're happy with the yield, like for example, everybody says Choice is the best of the breed. It's about 5 something distribution or dividend. So if you're happy with that and long-term investors, I think most of them fine investment. But if you expect a hope for a big move, I don't think it's going to come.
Let's hold on to that thought for the second question, which is on InterRent. What do you think about the takeout offer for InterRent? This one coming from Stephen in Ottawa. Basically, the chair proposed a takeout of InterRent. This was catalyzed by an activist investor who we had on the show, Moise Kassam of Anson, who said the stock's undervalued, go find strategic alternatives. And then there was a go shop period and no other bidder emerged. And it looks like this management-led deal or this chairman-led deal with another fund, I think it's a Singaporean sovereign wealth fund, that's going to be successful.
Yeah. Well, first of all, I bought a stock after your podcast.
Oh,
with Anson.
Great. Look at us.
So I listened to that Anson owned a lot of shares. It was not disclosed on Bloomberg, but they were making a lot of noise. So we made some work and we figured like the odds are something's going to happen. And then not only that, I bought many of the other apartment REITs because I figured if InterRent gets taken over, they all going to go up. But on the current situation, I think it's 1350. Stock trades lower. Not a lot of upside. They, it doesn't mean no deal is going to come higher, right? But there's a fee that people break up fee, I guess they call it, that people have to pay. I mean, if there's nobody willing to pay more than 13.55, that tells me that people are not very, like the big money, the big institutions are not that bullish either on Canada or on current valuation of REITs. So we've started to sell, but we haven't sold. Like the circular is not out yet. So we'll kind of wait for that. I think it's not too much risky to own it for at least until the circular is out. And maybe somebody else emerges and bid a little more. The NAV and is higher. So I would say, like, I think I was asking someone what's the cap rate at the current price of 13.55, and I think it's 4.7 or 4.8. So it seems very high. In other words, the valuation seems still today to be cheap. So.
Well, and I'm glad you brought that up. TD's Jonathan Kelcher downgraded the stock, I think last week or the week before, when it was clear that no other bidder had emerged in the go shop period. And actually said it's disappointing to see InterRent go at a 5% discount to the net asset value, noting there was really no distress in the business. And typically well-run companies with good assets go for premiums, not discounts. So I wonder if this is a fly in the ointment too. We've had a bunch of REIT people come on and say, oh, it's just so cheap. It's so cheap. Buyers are coming in. They're going to kick the tires. Like, does this set a precedent that even if you think a buyer is going to come in and provide relief, that it won't be at a premium that you were hoping for?
Yeah. I mean, anything is possible. Definitely, easy money has been made. But I would say, just generally speaking, if there's nobody else emerging, that's a sign for all the other REITs that people own that, the short-term upside is limited.
Okay. And we'll talk about that in ProPix because you did bring one idea to us that sort of got a lot of these characteristics. Our third question here actually is on a energy stock. What's your outlook on Whitecap and dividend sustainability? This one coming from Paul on X.
Yeah. Well, I think it's a very, very well run company. They paid quite a bit for the last acquisitions they've made. So I think they disappointed some investors. And basically it's 55. My understanding is 55. If the price of oil is 67 right now, so 7% dividend. So the dividend is safe up to 55. Even if the price went to 55, I would guess that management would not just cut the dividend right away. It would have to be sustained at that level or even lower. So I would say unlikely. So the dividend is fine.
They've got a 7% dividend yield, and the acquisition that you're talking about is of Varen, which is the former Crescent Point.
Yes. Yeah. And if you just look at simply the multiple, it's a little more expensive than many others that people can buy.
So, but you're not buying generally?
No, we're not in Whitecap. We're not in any oil producer for the reasons that we mentioned before.
Yeah, not bullish about the outlook for oil. Taking a different sector into account, we've got a question from Fabrizio on Instagram. Actually, two Canadian small caps that are kind of different, but the stocks have basically done the same thing. Kraken and MDA Space. Can you talk about either? I think you can talk about both. Kraken Robotics is for the sea, underwater exploration, and MDA, of course, is for outer space. And both stocks have had just this huge run.
Yes, yeah. We used to own Kraken, so great company, great technology. People, I believe some investors are buying that stock expecting Anduril. They're a very much bigger company. Would be interested in buying them down the road. Again, that's very possible. But on its own earnings, Kraken right now is extremely expensive, something like maybe 40 times trailing earnings, but people expect earnings to go up quite a bit. So over time, but the stock at the price it is, it definitely is, you're paying for already the next at least 2 years of earnings growth. And in the case of MDA, it's the same thing. Everybody hated it, maybe a year and a half ago. Now the stock has run up huge with the aerospace, generally speaking, extremely popular sector. Again, I found it's about 30 times next year's earnings. CEO sold a lot of shares. So to me, this is something I watched. Sometimes it doesn't mean anything, but sometimes it means something. They know more than you and me. So I just pay attention to those things.
Frances Hordelski, our former colleague with me at BNN, and she's been here a bunch of times. I know you know her. She says you sell for a lot of different reasons, but you only buy for one. So I wonder how you think about insider buying as a tell. If you see a CEO buying or CFO buying, do you view that as a clear bullish indication?
100%. We watch insider buying and selling like every day. And if it's only one person, a small amount, that doesn't mean the same as if there's 5 different people or one person buying a lot. So 100%. To us, you got to weight the significance of the purchase, but bigger, if it's big and by many people, many times it's a good sign.
We're going to take a quick break, but we got a bunch more questions in the mailbag. We'll be right back. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. All right, our next question in the mailbag is on Enterprise Group. Can you please let me know what you think of Enterprise Group? This one coming from Clay on Instagram, pipeline construction. So you don't own oil and gas producers, but do you own any ancillary companies?
Yeah, well, we do own some service companies. But this one, Enterprise, actually now what they're doing, like where the stock is up is because of their rental. They're renting some equipment to produce electricity and lower their carbon emission. And so they've done very, very well the last few years. But the stock has run quite a bit. And at the end of the day, it's a rental company and trading at something like 15 times earnings.
Is that too much?
Multiple to book. Yeah, I mean, you can buy energy service companies today for 2, 3, 4 times EBITDA.
And maybe you'll share one because I think you brought one in Pro Picks. Our next question is on WELL Health Technologies. Do you follow WELL? Do you like it? This one coming from James on Instagram. And I feel like we get a lot of questions on WELL. So I think there's a big retail holding base, but not a lot of people can answer because I don't think a lot of fund managers track it.
Yes. Well, I used to be involved and I'm not anymore. So I'm less in touch with it. The stock has pulled back quite a bit. But
it's a healthcare roll-up?
Yeah, they own some basic clinics. They don't own the doctors. I think it's just a physical clinic. And then they're bringing technology to be more efficient and save costs. And they want to keep rolling up. And they've kind of lost their momentum stock-wise. As you know, momentum is super important. So for a while, the stock was just going crazy and kind of lost it. So we're not involved on either side, long and short.
What was interesting to you about it when you were involved, and what would you look for if you were to get back involved?
Well, the CEO, founder behind it has had a tremendous success that we were involved with. Now, unfortunately, I forget the name of the previous company, but very smart guy.
Hamid Shabazi?
Yeah, I think so. But his company was public company as well.
Oh,
and now
yes,
I forget
you're right,
the name, but he made a lot of money for past investors.
Let me see. CRH.
That's it.
CRH Medical, yeah. So kind of just following a successful CEO.
Yes.
Okay, but not in it right now. Our last question in the mailbag is about Bitcoin. Do you focus on any Bitcoin or small cap Bitcoin companies? This one coming from Sold by Jacob on Instagram. I can't wait to hear the answer.
Yeah. Well, I kind of do because, I follow Bitcoin since the beginning, when the pizza was sold. Unfortunately, I didn't buy $5 million worth of Bitcoin. But, I follow from far away now because it's crazy, a little crazy. Today, for example, Trump just made I think it was a tweet that they bought $2 billion worth of Bitcoin, like the Trump,
yes, the fund.
What was for Truth. The Truth platform. Anyway, so you got now 150 roughly of different entities saying, now our new business is buying Bitcoin and you buying it at a premium. To me, that makes completely no sense. Why would anyone buy a premium, pay 2 times for the Bitcoin? If you're bullish on Bitcoin, you should just buy the Bitcoin directly. Like Microstrategy, for example, it's the most successful at that so far. It's trading at 100% premium. So if you want to buy one of these, I'd say, you go with the most known name. But to me, it's a zero-sum game, like owning Bitcoin and any of these coins is really a zero-sum game, excluding inflation. That's one of the reasons people buy them is for protection of on inflation. But if you adjust for inflation, there's no dividend, there's no, it's not a producing assets. So long-term, it's really a zero-sum game. So now we're stretched. The sentiment is extremely hot. If you look at Bitcoin and the other coins, once in a while, we get tremendous pullback, 50% and above that. And
do you get involved then, or you've just stayed out of it?
Yeah, I stay out of it. Yeah.
Even the mining companies, they have an operating business off of crypto. Not interesting to you.
Well, we were involved very early on that front. The computers producing Bitcoins, and I understood very quickly. It's a tough business because the formula changes every 2 weeks. So meaning it takes more energy to produce the same amount of Bitcoin. And every 2 weeks, again, it gets worse and worse and worse. So, it's been tough. So, yeah.
Not interesting. Well, let's find out what is interesting to you. We've got your pro picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Your first pro pick is Total Energy Services. So you're not into oil and gas stocks, but you do have a services company in Total Energy. Why do you like it?
Yeah. So I'm not bullish on oil, but I'm bullish on LNG in the world. So US has, been a huge winner. US is now above 20 BCF of exports per day, and they're going to 30. Canada, we're right now, 2 months ago, I would have said 0, but now we're at roughly 2 BCF a day run rates, and hopefully we're going to 4 and above. So that's why I'm bullish natural gas. And total has compression. And because of LNG Canada, the drilling aspect in Canada is very, very, very busy for the gas side. And hopefully we get even more news. Therefore, it could be for years and years to come. And then they also have their Australian business, which is also LNG. And they just bought a business a year ago, roughly, at 2 times EBITDA. They got a few more contracts after buying that business. So very, very, very good business, very, very stable. So the stock trades between 2 and 3 times EBITDA.
So how much of that LNG future do you think is baked into the stock? Because I'm looking at it, I guess over the last couple of months, it's up 20%, but it's still below where it was at the end of last year. So it's not like it's gone on to make new highs, even though, as you said, Canada's started to, ship LNG from that big terminal.
Yeah. On the service side, it's not really baked into it. Like partially is nobody's really interested in smaller cap names, as you know. Tourmaline is, benefit from LNG. Tourmaline has been a very successful stocks. People know that they benefit from LNG, but I don't think investors, generally speaking, have gone down market cap. Their source, which one of your guests mentioned at one point, also is a beneficiary of that as well. So I don't think it's in the stock at all. And we need LNG. Maybe people don't understand, but I think they understand more now, because if you go back just a few years, everybody was just talking, climate change, and all we need is wind energy and solar energy and no gas. Gas is bad, nuclear is bad. But with the AI stuff now, everybody understands that we're going to be short energy. And the only way to ramp up electricity production very fast, the only way right now is natural gas. So natural gas is going to be...
Which doesn't have emissions when it's being used.
Oh, there is, but there are ways to lower it. But it's 50% of coal. So right off the bat, if the world would just get rid of coal and replace natural gas as a first step. But in the shorter term, if you want to ramp up electricity, you could say for the next 20 years, we're going to go big on LNG, natural gas for electricity. And then longer term, nuclear, which is really probably one of the best. I mean, there's no emission.
What do you think it means for the stock? So trading at around $10, $11 per share right now, like what's your forecast on where you see it going, or what it should be worth with LNG baked in?
Yeah. I mean, imagine over time that we go to 4, depends on where we go, 4, 6, hopefully even 10 BCF 10 years from now. So a lot more production. I mean, the CEO of Strathcona mentioned they want doubling of oil and gas production in Canada. That is bullish across the board for Canadian producers and service companies. So, I mean, if you just run, let's say, a multiple, the 10, the earnings are expected to be roughly $2 over time. If they double their business, let's say 5 years, maybe 7 years, 8 years, and therefore $4 of earnings, that's $40 in 5 to 10 years. Right?
Okay, thank you for giving me the number instead of making me do the math myself.
But it's definitely not a certainty. People are so bearish on small cap, but there's definitely in the realm of possibilities.
And I guess half of the small cap game is just awareness, like getting to $1 billion market cap, and then getting on more and more people's radar and discovering the story, I guess, before that happens. Is that kind of how you find it goes? Yeah, sometimes for hot
stories, for sure, if you're early in finding out. But this is a well-established company. The company has been public at least since 1999.
But only $400 million market cap.
Yeah.
So
it's still $1 billion of sales. It's not a small company.
That's what I mean. Yeah, really under the radar. Okay, speaking of under the radar, your second pick is Calian Group. Did I pronounce that right?
Yeah, I pronounce it Calian.
Calian, okay. Yeah. Calian Group. Tell me what it does. Let's get our head around what it does, and then we can talk about why you like it.
Yeah. This company, has been around for a long, long time. They have kind of 3 divisions. They have base stations for talk to satellites. So if somebody needs to we're talking 20 years ago, they needed to build these big base stations to get the signals. And some of these technologies still need these things, but it's smaller and it's more sophisticated now. They have staffing business. So basically for either the military, because they do a lot of defense, that's really my angle why I like the stock, and for other industries. And they do also computer IT, like mini CGI for a certain type of clients. So they have those three, but the kicker is really the military. They have a lot of contracts with the Canadian military, staffing, for example, training, certain type of training they do for people inside the military. And we know now Canada will increase substantially our spending. So Calian indirectly or directly will benefit over the next year or two.
The ticker is CGY for those that are researching it. And didn't it just get a big contract or another big contract with the Canadian military? Did that kind of embolden your thesis?
Well, they announce contracts regularly, right? That's they need to get contracts. But Carney said we're going to go from 1% to 3%. Is it even 5% down the road? So imagine if, let's say it's 3% from 1, that's a triple of what like roughly Calian, there's a good chance that we'll get the same ratio. So 3 times bigger in terms of their military business. And the stock trades around 10 times earnings, free cash flow, no debt or very little debt.
I mean, I don't really see that show up in the stock. Like it moved like everything moved. It bottomed out in May and it's up from there, but it just hasn't really broken out much above $50 per share. That seems to be a stubborn lid, like $52, $53 per share. Why don't you think, everybody must be looking for ways to play on this higher defense spending? We know they are in Europe. Why don't you think Calian has seen that kind of benefit in its stock?
Well, it's a small cap effect again, but also the last couple of quarters, they disappointed. So some of the people that were involved in the stock got very disappointed, and some of them sold the stock, and the stock got into pressure. And you can definitely see by the chart that there's no momentum here. So momentum is popular these days. And so if they get the momentum going in the next few quarters, hopefully the stock goes a lot higher.
They've also got exposure, though, to the U.S. Is that right? And I think that's been a source of anxiety as well. Like, are they going to be able to win deals there? And with the U.S. maybe pulling back on spending, is that a headwind? Like, how much of a headwind is that relative to them being able to get more contracts in Canada?
Yeah, well, I definitely bet on Canada first. But their assets in the U.S. are, staffed by it's U.S. people, salespeople, or U.S. people. And the disappointment last quarter, a lot of that actually came from the U.S.
Yeah.
So, but because the stock is already at 10 times earnings, I'm not too worried, because you're already not paying for anything really that could come up here near term.
Okay, your third pick is a REIT. We tease this throughout the show. It's H&R REIT, which similar to InterRent, there's an activist, K2, a big hedge fund in Canada, agitating for more disclosure around who are you involved with in this kind of sales process. H&R disclosed that it's in the process of doing strategic alternatives, and reports say that Blackstone and others are sort of kicking the tires. When did you get involved in H&R, and what's exciting to you here?
Yeah, Blackstone, it's more than kicking the tires. My understanding is they made a full formal offer, or at least a formal official letter saying they're very, very interested. And personally, why I think like most shareholders involved here, they want to sell the company, all of it, either as a one piece or different pieces. It doesn't matter. But most shareholders want the management and the board to maximize value here, whatever the value is. I don't know. Some people say 15. Some people say as high as 17. Maybe it's even less than 15.
It's trading at 12 now, just for context.
Maybe it's 13. I mean, maybe it's worse than we expect. But because the willingness of basically most shareholders that I'm aware of want to sell, I think it's going to happen. And but if it doesn't happen, there's maybe a little bit of downside here. But I'd say the odds of something happening is high because of the willingness of the shareholders. So
it's interesting. You don't like to get involved in M&A or M&A as a thesis, but it sounds like real estate maybe is a bit of an exception, or help me reconcile those two thoughts.
Yeah, on this one, I would say my conviction is most shareholders want to sell. And if management or the board do something not to sell, you'll probably have activists getting harder, like going harder at them. And eventually I believe it will get sold.
H&R is pretty diversified, or more diversified. Like, it's not just like pure office or pure retailer. Like, it's got a bunch of things in there. Does that create, well, I guess on one hand, more opportunity, like you could sell off little chunks, but it also could be just a little bit more time consuming. It might not be just a nice, clean premium offer.
100%. That's why it was a lot cheaper. But yes, they are in 4 sectors. It's for example, retail, office, part of it is office, apartments, which is probably good. And then they got the industrial, which is very good as well. So it's the office that people don't know, because some of the offices that they own are, maybe the outlook is not very good. So.
All right, JF, it has been an absolute pleasure. Thank you so much for joining me in studio.
Thank you.
That's JF Tardif joining us of Timelo Investment Management. We are done the show, and make sure you stay tuned to our next episode. We've got Michael McCloskey on the show. He's a value investor with Greenskeeper Asset Management. If you have any questions, you can send us an email, questions@inthemoneypod.com, or find us anywhere on social media @inthemoneypod, and we'll see you on the next episode.